What happens when billionaires decide the Bitcoin needs a surprise market correction? You've probably seen the playbook, and yeah, it sounds like a series of unfortunate technical events. Take a decentralized asset class built on the promise of financial freedom. Introduce institutional whales who align with traditional Wall Street interests. Then, the liquidations begin. The only real issue is that the game is rigged against you. In 2013, it was the Mt. Gox bot manipulation. In 2017, a single entity moved the entire Bitcoin market to $20,000. Now it's the ETF era, but this time it's different because these whales aren't simply trading, they are pulling the threads of a global liquidity network that stretches from your MetaMask wallet to every gas station on the planet. This elite class of traders, often called shadow lords, defines the hierarchy of the crypto world through sheer volume. When we talk about a whale, we're describing an entity that holds over 1,000 bitcoins or 10,000 ether, giving them the mechanical ability to spark widespread panic or forced euphoria with a single mouse click. These players are massive investment funds, early miners from the pioneer days, and the very exchanges that facilitate your trades. The fundamental gap between you and them is a matter of patience. While the crowd reacts to every flicker of the candle, whales are busy engineering the very conditions that trigger those emotions. They understand that in a market without a plan, the crowd itself becomes the fuel. The most legendary figure in this hierarchy is Satoshi Nakamoto, the ghost who laid the foundation and then vanished, leaving behind a fortune of 1.1 million bitcoins. These coins have sat untouched for over a decade, yet they represent a massive psychological weight. Every time an ancient wallet from 2010 shows even a tiny sign of life, the entire market holds its breath. This potential liquidity acts like an invisible hand. The mere threat of these billions hitting the open market creates a pressure that professional analysts factor into every price model. If Satoshi is the silent shadow, Vitalik Buterin is the face of the active architectural whale. By launching Ethereum, he created a second center of power that isn't solely about money, but about the infrastructure of decentralized finance. When he moves tokens or suggests a shift in the network, the market reacts to the symbol of his leadership as much as the volume of the trade. These individual giants paved the way for the corporate whales we see today. Companies like MicroStrategy have moved beyond simple investment, rebranding themselves as Bitcoin treasury entities. By holding nearly 200,000 bitcoins, they have turned their own company shares into a proxy for the coin itself. When a player of this magnitude makes a move, it's a structural shift in the available supply in front of a headline. This evolution reached its peak with BlackRock entering the arena. Managing trillions of dollars, BlackRock has built the ultimate bridge for traditional capital through the spot ETF. They are shifting the very nature of market movement, making volatility institutional and creating a channel where traditional finance can finally meddle in the DeFi space on a global scale. This institutional takeover has brought a highly polished set of tools designed to harvest retail profits. Billionaires are now meddling in the markets through coordinated scams that use celebrity status as a weapon. We see this most clearly in celebrity coins, which are often nothing more than sophisticated cash grabs. An influencer uses their reach to pump a token to their followers, only to dump their hidden insider supply the moment the hype hits a fever pitch. Academic research shows these cycles are incredibly short, sometimes peaking and crashing in under 10 minutes. By the time the average person sees the trend on social media, the whales have already exited, leaving a trail of wrecked portfolios in their wake. As the market searches for the next big thing, the AI narrative has emerged as the latest golden gimmick. Whales are marketing AI-powered projects as the future of technology, but under the hood, many are just vaporware designed to attract noise traders. These are investors who buy based on buzzwords and sentiment rather than technical utility. This atmosphere allows whales to trigger massive rallies based on nothing but air, harvesting liquidity from everyone who is afraid of being left behind. It's a recurring pattern where the narrative changes from the metaverse to AI, but the goal remains the same: lure in retail capital to provide an exit for the elite. A more subtle version of this trap is found in curated investable lists, where hedge funds publicly endorse specific tokens. By the time a coin is approved for the masses, the smart money has already finished its accumulation phase. You are essentially being invited to the party so that the host can leave. This is the definition of exit liquidity. Furthermore, institutions use the ETF era to refine old tricks like wash trading and order spoofing. They execute trades against themselves to create a false illusion of volume and place fake orders on the books to trick trading bots. These tactics are used to hunt for stop-loss clusters, intentionally crashing the price just enough to trigger a wave of automatic sells, which the whales then buy up at a massive discount. The technical structure of the blockchain itself is being weaponized through Frontrunning. On decentralized exchanges, whales use sophisticated bots to spot your transaction before it's even confirmed. By paying a higher fee, they jump the line, buying the asset right before you do and selling it to you at a slightly higher price. This is a constant invisible tax on the retail trader combined with insider trading. Where people trade based on non-public knowledge of exchange listings, the market becomes a house of mirrors. A single billionaire can use hundreds of different wallets to make a coordinated dump look like a natural market correction, keeping the crowd confused and reactive. A year from now, we will likely see that the ETF era wasn't about bringing freedom to the people, but about capturing the market for the institutions. The liquidations we see on the charts are not random accidents, they are calculated harvests. From this day forward, any trader who wants to survive must realize that the price doesn't move where it's logical. It moves toward the most liquidity. Whales leave footprints in the data through abnormal volume spikes and sharp impulses that happen without any news. Learning to spot these tracks is the only way to anticipate the trap before it snaps shut. With the mainstream markets becoming a playground for billionaires, the only real sanctuary left is the community takeover, CTO. A successful CTO happens when the original corrupt developers and insider VCs are forced out, and the holders themselves take control of the project's direction. In these projects, the manipulation power of the elite is broken because the tokens are distributed among a grassroots community rather than held in a few central wallets. This represents a true return to the decentralized dream, but it requires the kind of deep due diligence that most people avoid. You have to look past the AI hype and the celebrity tweets to find projects with actual community skin in the game. Ultimately, the difference between being a victim and being a professional is understanding the market's hidden structure. Whales aren't necessarily evil, they are simply the energy of the market seeking the path of least resistance. They hunt for liquidity. And in this world, a crowd without a plan is the easiest target. If you enter a trade based on a curated list or a celebrity's recommendation, you are effectively volunteering to be the fuel for someone else's fire. So the question, after all, is not whether the game is rigged against us, it's whether we will continue to play by their rules or start reading the signs they leave behind. By recognizing the patterns of wash trading, spoofing, and narrative-driven traps, you can begin to see the charts for what they really are. Simply, a map of capital redistribution. Your only defense in all of this is a combination of knowledge and extreme patience. The billionaires are meddling in every corner of the market, but they cannot hide their volume. If the list is public and the hype is loud, you are likely the target. Stay sharp, look for the community-led gems that the whales haven't flooded yet, and remember that in a world of shadow lords, the only way to win is to stop being their liquidity. The choice is yours: become part of the harvest, or learn to follow the tracks of those who collect it.